The S&P retreated from a record high after investors sold JP Morgan following a miss on fourth quarter investment banking fees. Let's go to Doug Peta. He's chief U.S. investment strategist at BCA Research. Thanks for joining us today.
Thanks for having me.
Overreaction, you think, by investors to that miss by JP Morgan?
Yeah, perhaps a little bit, especially because I think the credit card interest rate cap is subject to revision. That 10% cap is hardly a final number. JP Morgan and the other banks will deploy all of the lobbying firepower at their disposal to try to push back on that limit.
I'm surprised that there seems to be so much concern about that one-off comment from the president, because, as you mentioned, it is something that will be hard to put through.
Certainly it will, but this very much fits in. The comment from the president very much fits in with the administration's desire to get on the right side of the affordability question ahead of the midterm elections in November. So I would expect that we're going to see more and more out of the White House about, at the very least, trying to appear as if the administration is doing something to try to bring down expenses for the rank and file households in the U.S.
What would you see as a fallout from something like that if it does come about, a cut in interest rates for 1 year?
Well, I'll tell you, the fallout that I think importantly would occur for markets is that if you were to have the White House or even any branch of government in the United States be able to cram down rules on businesses that previously were able to, within the parameters of reasonable regulation, make the decisions that were the best decisions for their shareholders, I think you would see the multiple that investors pay for U.S. stocks would fall. And I think you would see interest rates rise because Treasury buyers would be adding a risk premium that hadn't been there before to account for capricious decisions and heavy-handed imposures on the free market that hadn't been there before. So all in all, I think it would be negative for, again, stock prices. It would cause interest rates to be higher than they would otherwise be. And I think it would also weigh on the value of the U.S. dollar, as investors around the world would see the U.S. as a less attractive destination for their capital.
You've been looking as well at U.S. consumer spending, and despite slower job growth, Americans are still spending. Why do you think that is?
Part of it is that they cut their savings rate by a full percentage point from the first quarter, from 5.2% to 4.2% in the third quarter. So if you spend more of what you earn, if you set less aside in your paycheck every couple of weeks, that will allow you to spend more. Unfortunately, that one is probably not all that sustainable, because now the savings rate at 4.2% is very low relative to history. And that suggests that households don't have much more scope to reduce their savings. On the other hand, households have not borrowed very much in this cycle, and therefore they do have dry powder in terms of borrowing capability, and that is something that would allow them to maintain consumption at a fairly robust growth rate, even if their income was growing at a slower rate, if their income wasn't growing enough to support the consumption. But I think those are kind of quick fixes. And the route to more durable strength in consumption is for household incomes to pick up, for compensation to pick up. And the only way that happens is if we do see hiring begin to pick up. It has slowed to an absolutely anemic pace.
Do you think there is more enthusiasm from consumers because the interest rates have started to go down, that puts a little more money in their pocket instead of going to the mortgage, perhaps? And also, I'm sure there's a lot of expectation around tax cuts that are coming for them this year.
The tax cuts should be helpful. And all in all, lower interest rates ought to be as well. I'm not sure that it was interest rates that have dampened consumer sentiment and have dampened hiring. So our view is that at the margin, very slightly at the margin, lower interest rates will help. And we do expect that the Fed is going to cut rates more than markets currently expect. Right now, they're pricing in 50 basis points of cuts in 2026 because we think the weakness in the labor market is going to prove to be more durable than it might appear at first blush. We think that the Fed is going to have to be cutting more in 2026 than expected. By itself, that would be good, but that's a little bit of a case of be careful what you wish for, because if the Fed is cutting rates because the economy is weaker than had been perceived, that doesn't necessarily help stocks. It doesn't necessarily help consumption, because part and parcel of that is that it becomes more difficult to find a job. So if the Fed cuts more than expected because the labor market is weak, we think that the labor market weakness will outweigh the boost from lower interest rates.
Doug Peta, got to leave it there, sir. Thank you very much for sharing some of your time for the program.